Hi everyone, this is Payton from InsuredTY. Today's another video of Invest and Insure. Today's topic is stocks versus bonds and the risk score by age. Let's get right into the video. So as always, our mission statement, that's to provide financial security for immigrant America. As I've stated multiple times in previous videos, I'm from a very diverse suburb of Chicago in which there's people from all parts of the world living there. Because of this unique upbringing, I'm very passionate about helping others, and luckily at InsuredTY, I could do that. Investing. Investments can be many things. In this example, we have pictures of more or less investments to society, such as early education and public parks. Insuring. As I said, within investing, it can be many things. In this example, of course, we have the Captain American shield that shows defending from danger. Another great example is business insurance for grocery stores. They purchase business insurance in order to protect their inventory. Finally, we have three different profiles: stocks versus bonds and the risk score by age. We have the 22-year-old, the 45-year-old, and the 67-year-old. All three different individuals want a different stock portfolio composition, with the 22-year-old being the riskiest, and the 67-year-old being the safest or the securest. So breaking down the risk score, we're going to start with the 10, as you see here, risk score of 10. Municipal bonds are only 2%. So virtually at this level, it's a 98-to-2 ratio. So stocks are going to make up around 98% of the portfolio, and bonds are only going to make up 2%, meaning this is a very volatile portfolio. Moving it to a risk score of 5, we see more or less a 60-to-40 ratio. Obviously, bonds have been moved up significantly to around 35%, excuse me. And then we have still fairly high stocks. Moving on to a very low risk score, a risk score of 0.5. The bonds are very important, not just municipal bonds, also U.S. government bonds and corporate bonds. And that makes up virtually the whole profile at this point is made up by bonds. So here we have the Thrift savings plan. This plan is used for someone retiring in 40 years. As you can see in the current day, indicated by this line, someone in their 20s would have their portfolio made up of mainly S&P 500 stocks, a small percentage of small cap stocks, and also some international stocks. Moving on to the end of the spectrum, around July 2060, when they would be retiring, the vast majority of the portfolio at that time is made up by the bonds, obviously because they're a lot more stable and they're less volatile. There you go. Awesome. Moving on to some recommendations posted by the Financial Samurai. This is the proper asset allocation model, and it is in regards to age and what percentage of stocks versus bonds you should have in your investment portfolio. 0 to 25, you see 100% of stocks recommended, 0% bonds, all the way up to 75 plus, in which you have 25% stocks and 75% bonds. So it's very interesting to note the difference between the 0 to 25 age and the 75 plus age and the difference in investing. Finally, moving on to the Vanguard graphic. This, similar to some of the other graphics we showed previously, this pretty much shows the difference in your portfolio from the ages of 50 years to retirement, until retirement, and after retirement. So you could see 50 years before retirement, like I said previously, your portfolio is going to be made up of mainly U.S. stocks and international stocks, very small percentage of bonds. Moving on to when you're older, the vast majority of your portfolio is going to be primarily bonds, especially after you retire. As you can see, the 5+ years after retirement, that portfolio is a bond-dominated portfolio without question. Thanks for watching, guys. Be sure to check us out at www.insuredty.com/schedule. And we look forward to seeing you in a future video.